You're listening to Toronto's #1 real estate podcast, powered by Watson Estates. The most successful local real estate investing starts right here, right now. Here's your host, broker, investor, and social media influencer, Bradley Watson.
Good morning, investors. Bradley here from Watson Estates. Thank you for tuning in. We are #1 on iTunes, Spotify, and Google Podcasts for Toronto real estate. Thank you to our listeners. Thank you to you, and thank you to the comments that we get. In fact, we like to put together every single morning all the news, the big stuff that's coming out and as it relates to our marketplace. And today, I'm happy to report the best news, or the most interesting news, is from our listeners, from you guys. The comments have been unbelievable. In the last 24 hours, we've put out information about kind of an update on what's going to happen this month. If you missed it, go back. This morning, we dropped another podcast, which was on our video yesterday, talking about whether the market was going to boom or bust. And from those two things, we have a ton of comments with your take on what you think is going to happen in our marketplace. And so I want to start there, because what's the whole point of this entire thing unless we can figure out what we should be doing with our investments? So we're going to start off talking about, will we see a boom or a bust in Toronto in Q3? And then there was a wonderful article that I want to share with you. I learned some stuff and it ties in nicely to what we've talked about in mortgages lately. This idea, this advertised HSBC 1.99% rate, you've probably seen it. Is it a scam? Like, actually, is this a scam? I'm going to talk to you what the details of that are. Love this article. I'd love to share it with you. And then when will we see further rebates for Toronto's municipal land transfer tax? This has been an ongoing discussion, and it seems as though in the next week we'll maybe hear some more information on that, which would help people with affordability, which would, of course, boost our market. There's a ton of good stuff going on. And I just yesterday received a pop shield in my mailbox. What that is a little thing you put in front of your your little podcast mic. And really, it's to protect your ears mostly as I'm talking moistly. So I'm doing my part with COVID-19, trying to protect your ears, protect all this spit. I don't know how bad that hit the. Now I gotta wipe this down. Sometimes there's people you talk to and that you wish the 2-meter thing always applied. We got some good stuff today, guys, and I'm excited to talk about this first topic, this idea of whether or not our market. Let's get a new lay of the land. Thank you, and we're going to give shout outs to everybody who left comments that I thought were worthy of sharing, and there's some really good ones, especially on Reddit. Surprisingly, Reddit people, you say real estate agents are biased. You go on Reddit, there is a definite bias, almost the opposite. It's the opposite of realtors. So it's a wonderful forum in getting counterpoints that keep you humble. And I'm going to go through some of the points that they have to say on what they think is going to happen. And we're going to talk about, I want to ultimately share my thinking on what is going to happen in our market, because I am very good at hiding behind the news. And I want to kind of take a step outside the veil and share what my thoughts are on all of this. Okay, so the first comment comes from Brash 2019. Now, I don't know if it's brash or be rash. He is a little rash in his comment. If it's a he, I don't know. Personally, I don't know what to think. When this happens, I make a list of pros and cons and see where it takes me. Most importantly, I only use verifiable facts for my analysis. This is good on you for the passive aggressiveness. It's great. So he says this is the negatives. Let's start with the negatives and get them out of the way. Record number of condo finishes at the start of the depression and recession. So in other words, way too much excess in inventory. 700,000 mortgage deferrals in the country. Canada is top 7 countries of debt to income ratio. So too much debt. Unemployment is at 13%, but 19% if you count those furloughed. No foreign investment or immigration to buy housing stock. Banks, CMHC, and other experts are advising against buying unless your financial situation is robust. That's the negatives. You want to hear the positives? It's Toronto. Everyone and their mother wants to live here. Real estate agents are not worried and encouraging me to upgrade my place. How can they steer me wrong? Not all of us, but many. I think people who don't give a full picture, the default in our business would be market's going to do good. And historically, that's true. So generally speaking, it's good advice. But unless you're following it day to day or month by month or week by week, how are you going to give a full picture? And let's be honest, everybody commenting here doesn't have a 100% full picture. We all have our own impressions on what's been going on. And this is why it's important for you as investors to not just listen to my voice and all of a sudden just throw your money. I listen to a ton of podcasts. I listen to a ton of investment forums and what people say. If I were to invest in everything that they say, I would be broke. So it's important that you analyze and that you know the numbers yourself, you know what you're going to do, and you're going to be committed to your plan, nobody else's. Never, a good rule of thumb for investors is never invest in something you don't understand. Anyways, he continues, real estate never, ever depreciates in value in Toronto. He's being super passive aggressive. It's pretty comical. Did I mention everyone around the world wants to buy real estate in the city? So he said this, I think the answer is clear. It's going to be a banner year for real estate in the city. Time to buy, buy, buy. Okay, we get your point. So don't buy. All right, moving on. Next comment. Foot for life. This one had a more substance to it. I like it. Mortgage deferral expirations is the key driver, in my honest opinion. I agree. Mortgage deferrals. Watch mortgage deferrals. Okay, guys. I can't see. There's a lot of moving parts. The other one that I would wonder about is the actual virus itself, but it's so hard to track that. Mortgage deferrals, we should be watching this super closely. We'll see who was naked all this time when the tide washes out. Okay, wait a minute. How did you know I was naked? Is there a camera in here? I've seen varying forecasts, but only time will tell. We're waiting until Q4 this year to see how that plays out. I don't know this person, but very smart individual. I agree with what you're saying. I totally agree with what you're saying. Next comment comes from Dave the Dude. You convinced me that the Toronto market is going to crash. This comes out of the video we did. Good. I'm convincing. Again, I don't know. Sometimes it's hard to tell if you're being facetious. All the reputable sources like banks and CMHC are calling for it. Only real estate agents understandably are saying it won't, as their livelihood depends on the myth that prices can only rise. I agree long-term prices will rise to a new high, as they have always done in Toronto. The problem is the short to medium term, where you could see be the bag holder for 10 years waiting for the recovery. So, I mean, the only thing I think I don't agree with there is 10 years is, I don't know if 10 years is considered middle term, like this long term begin at 10 years, maybe. But regardless, this is the game, right? Short to mid term. I think we have a different understanding of what medium term is, but I also think what he's suggesting here is the recovery could be long lasting, which is true as well. But even the people that are forecasting big problems, they're not talking 10 years out for recovery. We're talking less than 5 years. So regardless, I get the point. Thank you. There was another comment that came here from Tobram, and very quick comment. This is it. He said, no brainer. Boom before 18th of March 2020. Bust after July 1st, 2020. You should sell stocks. So pretty much the point here is middle of March, right? Pretty much I'd say the 15th, but he's saying obviously as of the closure until July 1st, it'll bust. And the logic behind that, see, if you didn't know what we're talking about here, this wouldn't make any sense. But what they're suggesting here is many people are concerned about the second half of 2020, and that begins on July 1st. That's how I read that. Guys, it's your call. I'm going to give my 2 cents in a second, but I'm doing a video call, a podcast, which is going to go next week live with the CEO of Rain. I'm so excited. And they represent investors, not just realtors. Okay, so if you're biased about realtors, this is a good podcast interview to listen to because this is talking on behalf of investors. Let's see what he has to say about the market and make your investments based on that. Here are my thoughts going into this meeting. Okay, so I could bite myself. Okay, I could really hurt myself here, but here's my thoughts. Okay, just looking, if you were giving me like a summary, if you went all in between March, late March, so we're talking like the 18th on, I'd say probably later than that even. Let's say the very end of March until mid-May. You are the winners. You experience a good 8 to 10% drop in prices. Whether the prices go up or down from now on is regardless. You just got a good deal. Like, can we just agree on that? You got a relatively good deal. You are winners. Now, let's put ourselves in the shoes today. This is a different market, okay? People are coming to me and say, oh, it's such a good buying opportunity. Where you been? You don't listen to my podcast, do you? If you are investing today, let's say you're making the decision to invest today, I would want to make sure that investment is at least 5 years. Like I would want the certainty of knowing as an investor, don't do overnight year by year trading right now. If you're going in, okay? Generally speaking, I would say 5 years is long term. That's kind of how I look at it. But let's say five plus years, you're going to want to make sure, regardless of what happens, you're going to come out shiny and bright on the other side. But if you're sitting out today, let's say the decision, I'm not going to invest, I'm going to wait. I wouldn't let that linger too long. I would go max 1 to 2 years. So if you wanted to wait out the second half of 2020, you're thinking, okay, even if it goes up, my upside is a lot less concerning than my downside. I see that as a valid argument. I buy that argument. Okay. I mean, I think it's kind of silly when people, I get that agents are generally optimistic about the market, but I think it's silly when you accuse me of wanting the market to always go up, because when the market's going down, people are selling. There's still deals. Whether people are selling or people are buying, there's deals all the way through, right? If anything, I wouldn't want things like rent to go down, right? Because that would affect investors, right? So anyways, regardless, these are my thoughts. So if you're investing today, make sure it's for the long term, as always should be the case, by the way. Don't day trade real estate. But if you are going to kind of sit on the sidelines as a day trader-ish, a monthly trader, you trader, then I wouldn't last too long, okay? Like, just keep in mind that even the bad forecasts are only talking a couple years out here. So if you're waiting for a dip in prices, great. You're really taking a risk, though. You are taking a risk. Just be aware of that risk. That's all. Okay, those are my thoughts on everything going on right now. Okay, there was an article that came out of movesmartly.com. Love the publication that they have coming out of this place. It's always good. It's always fun. It's always insightful. And today they're talking about, the article is called, it kind of spells itself out, Beware the Siren Call of HSBC's 1.99% 5-year fixed rate mortgage. You guys know that 1.99% mortgage you're hearing about all in the news? It's all over the place, right? I've talked about it a number of times. The spring real estate market is showing signs of life in the usual big bank low rate teaser. This is an interesting point. There is an annual tradition in the Canadian mortgage market whereby a large bank grabs the headlines with an eye-catching rate as soon as our spring real estate market kicks into high gear. Fascinating. So are we in the spring market now? That's what I'm hearing from there. True to form, now that our regional real estate markets appear to be emerging from their extended COVID-induced slumbers, HSBC is offering a 5-year fixed mortgage of 1.99, putting them less than 20 for properties less than 20% of the purchase price of a property, commonly referred to as a high ratio borrower or mortgage. This is an interesting point that they added here. Definitely valid to know. If you're wondering why is it that if you put less than 20% down, you get better rates? Well, the logic here is that you're also paying for default insurance premiums. So because of that, they're actually lower rates, surprisingly. Now, do we intentionally put less than 20 in order to get these low rates? No way, because this default insurance ends up costing you more. So it's just an incentive. These are incentives. I will use, this is what this article does, HSBC's offer to illustrate why the terms and conditions in your mortgage contract can end up costing you much more than a small difference in rate over time. Very interesting point. Okay, so this article continues to go on to explain the differences in terms and conditions and how even though you think you're getting 20 basis points off, it's not the case. Your terms and conditions dictate how much flexibility you have over the length of your contract. Now, I know mortgages are not sexy, okay? That would be actually a really interesting brand, like the sexy mortgage broker. I'm not even going to go there. Let's not go into stripper mortgage broker names. They're going to leave it there. Okay. Anyways, these are some of the examples of terms and conditions. Okay. Let's say there's a job transfer or career changes or job losses or changes in your family structure or simple desire to trade up. You want to move up, what they call porting your mortgage. These are all conditions that are behind the scenes. And I've said it before too. This article is driving this point home. Don't get sold on the rate. Don't get sold on the rate. Know the terms. And if that means you need a mortgage broker you can trust to get you there, great, do it. Many borrowers, when they are at their most vulnerable, are shocked to learn that there are huge differences in fixed rate mortgage penalties charged by different lenders. Do you guys remember that article where there was this, it was a really strange one. It was a realtor, but it seemed like they had some kind of law background, and they were found out that they ended up having to pay tens of thousands of dollars. I can't remember the number now. And it was all over the newspaper. It was like, these banks are screwing us all over the place. And do you remember what our podcast was? Like, no, you're an idiot because you're a real estate professional. You should know. So this is a little bit of a recall on this, but it also highlights this particular case and this particular rate. In the example I provide below using today's rates, HSBC would charge you a penalty, this same mortgage, of $23,000 to break your mortgage, while a competing lender with a rate that is only slightly higher today would charge you $2,000. Makes a big difference. And the majority of mortgages, at least this is my understanding, get broken around 3 to 4 years. That's the numbers that I've heard. We'll see. Using a $400,000 mortgage to compare. So what they did, they compared this rate of 1.99 versus a rate of 2.13. And they said that overall, for the 5 years, you're going to save $2,600 generally for having used this mortgage. That's your deal. But then they go on to talk about this thing called interest rate differential. And it's a fancy word of saying we're going to recuperate the interest we would have had. So you can either have a penalty of like 3 months, or you can say, well, if you break your mortgage, I would have lost out on all these interest payments for having you leave. So now you're going to owe me all of that at this rate that we set, called the interest rate differential amount. And that calculation can cost you a fortune. In the HSBC example, $23,000, whereas a lender alternatively would be just under $2,000. So then he looks at these two examples of things you'd use. So these are some of the things that you'd have scenarios, right? You'd have mortgage rates fall. Now, some people are like, mortgage rates fall? It's impossible. Guys, we don't have the lowest mortgage rate. Like, there are other countries with lower mortgage rates. It's possible, okay? So let's say it were to hit 1.5. Immediately, based on this article, you would have a net savings of refinancing at $4,500. So that's already allows that flexibility that was locked in and wouldn't have been allowed in this, quote, low interest rate today. Also, scenario 2, let's say you need to sell it. On certain times like these, there would be a penalty will result in one less zero on the dollar side. So if you can save yourself a bit of cash, great. Here's what he put at the very bottom. The bottom line. Both 5-year fixed and variable rates continued their slow decline last week as COVID-related risk premiums continued to shrink. This is now a well-established trend that should continue in the weeks ahead. Interest rates are not going up. They're going potentially down. Doesn't have the same ring to it. I'm not singing Kesha again. I'm not singing. Okay, all right. Let's move on. We're going to go into another interesting topic. This news, actually, I could have done yesterday, but we were so heavy for topics, and it wasn't time sensitive, but it is super important, so I wanted to get it out here today. This idea of a rebate for a municipal land transfer tax. Let's get everybody up to speed. Anytime you buy in the province of Ontario, pretty much any province with a couple exceptions, Alberta and Saskatchewan, they have smaller fees, but the rest of us, we all got to pay provincial land transfer taxes. At the same time, Toronto has made the executive decision to add a municipal land transfer tax. Will that be going away anytime soon? Probably not. The city is a little too tight to be pulling that maneuver right now, but there was this idea of a rebate that existed pre-COVID. And it kind of got pushed off. It got delayed because, like, this is the least of our concerns. This is kind of the same reason that I always said, like, this first-time homebuyer incentive that they got, they wanted to change it. But, like, I was saying a month ago, don't expect anything anytime soon because they're too busy paying everybody billions of dollars in CERB. So this is the same case. But this got tabled and things are starting to reopen. And so there's now a new conversation happening. Okay, when is this going to happen? So as a first-time buyer, there are rebates available to you for the provincial land transfer tax, but also for the municipal land transfer tax, and it's quite a bit of money. So the question is can we boost that amount up? Currently, your home they give you up to $400,000, which we all know is next to impossible. The average house in Toronto is $955,000, which is up 2% year over year. And so you can't expect these numbers to still work. So we need to amend it. We need to increase it. And according to the report, if council decides to amend municipal land transfer tax rebates or even signal its intent to make specific changes in the future, in-year real estate market reaction, i.e. real estate sales, and municipal land transfer tax revenues changes could result. As such, the report says changes to the MLTT rebate structure should be considered as part of the city's annual budget process. So this might not happen overnight, and nor do I think it should. Like, I don't think we should be throwing more money. I mean, I think there's plenty of demand, but I mean, who am I saying? So this report is slated to be presented. There's various in this article. They give various scenarios. I don't really care because I don't want hypotheticals. I want the actual scenario. So we're going to hear that. And it's going to be presented on June 22nd, which is on Monday, to the executive committee. So we will see what happens. Let's see if, I think this was one side article that came out. I would expect that in a week's time, if a decision is made or when a decision is made, this is going to be big news. Okay. So let this just kind of be a tip. Again, not time sensitive, but it matters because next week we're going to get some more info on it. And that'll be interesting to see the direction, because if you can assist affordability, that's good. That's good for our city. On this comment, this idea of who needs help. Okay, I had an amazing question. Amazing question. So this came, I don't even know how to say this person's name. Patate Duce 85. I'm not gonna play around with the name. This is an awesome comment. I love this comment. Listen to this, and I want to give my thoughts on it. Okay, and it's kind of diving a little bit into the market. I'm reluctant to dive into any specific neighborhood, but I like to talk in general because there's such a vast number of listeners. But I think from the idea of affluent neighborhoods, this question of like, if you're in an affluent neighborhood versus an up and coming neighborhood or less desirable neighborhood, here's the question. Would you be able to give your thoughts on whether or not affluent neighborhoods would be equally as affected as other parts of the city by the possible bust, or less affected? My partner and I live in the West End Junction in a condo and would love to stay in the neighborhood, but most houses are well above our budget. There's lots of doctors, lawyers, university professors, etc. around here. We're debating whether to just take our house hunt to a more affordable neighborhood, or should we wait out the storm and see what 2021 brings us? Okay. Condos is kind of a different question. There's different condos, because right now there is definitely a trend in favor of getting a backyard, right? Like we can't ignore that. And people who are moving out of the city are looking for that. And if they can stay in a place where they can get to work, although everyone thinks they're just going to work from home forever now, to be close to the city is a good thing, and it will be a good thing in the long term. But this question of affluent neighborhoods, are they more affected? And I would say that yes, they are. But hear me out, okay? They are more affected, and the reason for that is because the price points are higher. So let's say we have a 5% drop in prices. That's going to hit everyone equally, but if your home is worth twice the amount, that's twice the drop, if that makes sense. But here's the flip side. You also find affluent neighborhoods rebound much quicker. I would say in the last month or two, the areas that have continued to maintain multiple offers and bidding wars, and that will continue to be the case, or most likely to when the rebound happens down the road again, every time this happens, that's where people want to be. So those areas bounce back so much faster. So if you're okay, generally, if you have a high price home, you should be more okay with the flexibility, the fluctuations, but you also have a little bit more stability on the tail end of it. And they're also currently, with this crisis, those areas aren't as affected by unemployment, of course. We've seen the majority of people being affected right now are first-time buyers or people who are on the lower end of affordability. They seem to be getting hurt. They're the essential workers. They're the ones losing the job. So I am far less concerned if you take everything for affluent neighborhoods. But yes, they will be more affected in the sense of price drops because the prices are higher. However, oftentimes those people don't need to sell, right? Because they're not as impacted at times like these. They've got cash reserves. There's a reason they're in an affluent neighborhood. And so they just take their property off the market. It's this idea of prices being sticky, right? There was a great example that I had heard, and we put on our podcast probably a few weeks back now. This question of unemployment, right? You can have unemployment be affected, but in the short term, it doesn't affect wages because it's sticky. It takes time. But if an unemployment continues to get hurt, then all of a sudden that impacts wages in the long term. And it's the same idea with prices. When it comes to sales, you can have a change in sales, but prices are sticky. They don't just drop with sales. If that was the case, we would have seen a 60% drop. That's not what happens. And so with this stickiness, I would say they're extra sticky in the affluent neighborhoods because, like, unless you've got your business tied to it, but again, like, generally speaking, affluent people, right? The lawyers, the doctors, people that are working from home and aren't affected by COVID, they're going to make fine. If prices do come down, keep in mind if crap hits the fan, you're going to get some on you, right? You're going to get some on your little pretty white blue collar or white collar shirt, right? But they will bounce back first. We are at a crossroads right now, today. It's funny because it's not a bad plan to buy right now because there's still a price discount relative to March, not year over year, but relative to March. And it's not a bad idea to sell, right? Because pending the uncertainty, if you have investments of Q3 and Q4, if those freak you out and if you're planning on getting out in the next year to 2 years, then now might be a good time to get out so that at least you're not caught in the middle. But if you're planning on investing for 5 years, then why sell ever, right? Like what's the point in selling? That's when you pay all the fees. So I would not day trade real estate. If you're talking housing, you're talking a place you live, it's great that you're interested in what's going on in our market. That's a wonderful thing. Good for you. I would be a little bit more careful with your primary residence. I love the idea of having a renter in my basement, but my wife, not so much. I have a daughter. And so I take a haircut on my own principal residence. A principal residence should not necessarily be treated as an investment, if that makes sense. Investments are strictly money-based decisions. Where you live, let me ask you the question, if I were to throw it back at you, would you be comfortable taking your partner and going to these areas you're considering moving to? If you had the choice, would you do it? And I'm assuming the answer is probably no. So most likely, I don't know everything in this scenario, but most likely I would just stay put, man. Keep your beautiful home. Damn realtor. Always trying to sell my property. But it comes down to what you're doing. And I hope this gives some insight on the difference between what I'm seeing in affluence versus up and coming, if you're going to be optimistic about the other side, and more affordable housing. The last 2 months have been great deals, but they're drying up very quickly. Year over year, we're up at this point. And I think you might even in the next month or two, I think you're going to see some more growth in the upwards direction. And then obviously the thing I'm paying most attention to is this mortgage deferrals. The other thing we need to be paying attention to is the reopening of Ontario. Premier Doug Ford wants to extend Ontario's state of emergency to July 15th. We just heard they extended it to the end of June. And we got to be careful. We're treading on dangerous waters because all the forecasts that first happened at the beginning of the year were dependent on how quick we can rebound and reopen. And the good scenarios were in the summertime. The not so good scenarios were by the fall. If we miss the fall market, good luck. I think there's signs we're in the spring market, so I'm more optimistic that way. But we need to get the doors starting to open again, obviously in a sensible way. I hope you guys learned some fun stuff today. We're going to keep our finger on the pulse of Toronto real estate, if there's a pulse at all, by the end of the year. And in the meantime, today I'm going to go get dressed because I'm cold. It's cold. Don't judge me. It's cold in here. I see you judging over there. That's it. That's all. We are number one on iTunes, on Spotify, and on Google Podcasts. I'm so excited to continue to join you with you guys every day. We're partnering together and to be of service. If you guys have any other questions or comments, leave them. And I look forward to seeing you again in the morning. Take care and keep it real.